Coming off their biggest monthly decline in more than 8 years in October, and according to one strategist at Evercore, there's still reason to proceed with caution, saying in a recent note the S&P 500, quote, remains weak and vulnerable below 2817, with crude, credit, tech and trade all going the wrong way. Joining us now with more, the man behind that call, Richard Ross, Evercore ISI Head of Technical Analysis, and Dennis Debusschere, Evercore's Head of Portfolio Strategy. Rich, let's begin with that call, shall we? What underpins it?
Yeah, so look, what we've seen with the S&P this year is that after a very strong trending phase in 2017, we've settled into a highly volatile, non-trending sideways phase. Now, the internals of the market itself have become increasingly defensive. We've seen some erosion across key sectors like technology, while at the same time, the macro backdrop, crude, credit, currencies, all trending in the wrong direction after providing a tailwind for almost the entirety of this bull move, which commenced in late 2016.
Dennis, it's been a really strange year. 2017, you got a participation medal just to having capital allocated. 2018, everything has got hit. What are we in store for in 2019?
Yeah, I think 2019, the way we would phrase it is fairly priced for low forward returns. I should offer a caveat, though. We are neutral on risk until trade is, quote unquote, figured out. I define that very loosely, by the way. But
can you get to the definition of that? Because I'd love to know what that is.
The first one is a ceasefire.
Right.
On January 1st, we cannot go from 10 to 25%. If that happens, the market's going down, in our opinion. Assuming there is some type of ceasefire, and maybe that's a heroic assumption, but there's some ratcheting down of trade. Even if you get past that, I still think you're in a relatively low return environment. What I think is critical for investors to understand is that the Fed is trying to ratchet down demand growth. They're trying to move growth from the roughly 3% rate we were running at to closer to 2%. That means lower earnings growth in the context of some weaker international growth and a multiple that's unlikely to expand much.
So, Rich, let's pick up on the trade story. There is a belief that if we do get a ceasefire, loosely defined, at the end of this year, we'll get a year-end risk rally, that we're primed for a squeeze. Technically speaking, are we primed for a bit of a squeeze?
Well, you might think that given the magnitude of the decline, some of the oversold conditions, but admittedly, that's sort of a loose argument. Now, of course, I think most of us can agree that trade resolution would be a positive, but not necessarily a panacea. And when we talk about a year-end rally, that year-end is really coming up a lot faster. I mean, we're talking about Thanksgiving this week. We're running out of field to work with here, and the technical underpinnings of the market are not strong. As a technician, I need to trade what I can see, not what I think we're going to see around the next corner.